we'll take a look at this oil contract out here.
Let's get ready for those 10:30 numbers.
Yeah. Okay, so if you haven't test drove the Nadex platform, folks, great time to do it. Come over to our website at TFNN. You can see the banner. Hit the banner, bring it up. They'll put $25,000 of paper money into your account, and you can follow along with us as we trade these defined option contracts.
So do you know if you're looking to trade it one way or the other?
I am. I'm bullish.
You're bullish, okay.
Yeah.
So right now,
that 50 wants to get hit. That's
so
what
right
looks
now
to me.
the oil's trading at about, we're looking at the November contract, about
Okay.
49.55.
Okay.
So I'm just looking at, I call it like 49.50 in my head because it's going to be real easy, and that there's ones with 49.50 right at the floor.
Okay.
So this would probably be a nice trade if you're looking for a decent move to the upside and you're bullish. In the market right now is at 2 pennies above 49.50.
Yeah.
Right? So there's 2 pennies of actual intrinsic value in this because the floor is 49.50.
Yeah.
And you're going to be paying like about 20 cents in premium, it looks like. So
Okay.
you're risking 24 to make 126, and that's the $1.50, and you have profit up to $51.
And that's going to 51. That's pretty good, man.
Yeah, so now that's an 11 a.m. You know, that gives you the half hour that we're looking at these 10:30 numbers.
Yeah.
But that's a nice trade that I know that way you're risking 1 to 5 almost, which is a nice risk reward.
Okay, so let me just look at this for a second. I'm going to put the USO up just for a second.
Go for it.
Okay, so this baby here. Oh, this is interesting. So, pops. Let's push him with volume, man. Yeah, I'm going that way instead of going both ways. Yeah.
I know. I was going to say, we'll look at it real quick anyway.
Let's look at it both ways anyway. Yeah, but
to see the risk reward that you can have, because it is nice when you have where we're literally at 49.50 and the floor and the ceiling are going to line up at those
let's look at the other one also. So what we're doing, folks, we're looking at both sides of...
Now this is perfect. It's literally going to be trading on the dot at 49.50. So here's our bullish side, right? 49.50 to 51.
Okay.
And then we got to get our bear side. Bear side is going to have the same price point, but for the ceiling. 49.50 is the ceiling, but then we have a $1.50 to the lower side.
Okay.
Be selling that. Really, it's going to be almost identical risk rewards because it's at almost 49.50. Each one is going to be all premium that you're paying here. Same thing. You're going to be risking 23 for the 127. Your max loss, right, is if this expires on the dot at 49.50.
Oh, I like this. So I like that trade.
And then you have $47. So that's going to be about 47 cents, give or take.
Okay.
From 49.50. You know, your total investment here is $47.
Yeah.
That's your defined risk. And what you have is so one of these would have to move, if you hold them both until expiration, 47 cents away from 49.50. So you're looking at basically where, if it expires anywhere outside of from 49 to 50, so you're looking for it to expire above 50 for profit or below 49 for profit.
So this is
interesting. You need more about 50 cents movement in either direction to start making profit.
So what happens is that if I go...
and we're literally at the, to the thousandth of
this is what's pretty cool.
Right at the dot.
Like, I'm bullish. But when I look at that, I'm saying to myself, okay, I'm risking $24.
And you're trading volatility here. You're just looking for a big move.
And I'm still looking for more than 50 cents. Even on the 24-cent one, right?
Now, the other side of this, though, is that on the 24-cent one, when you're just going directionally, which was this one, where you're just going bullish, right? You're going to lose that entire 24 cents a lot of the time. Or you're going to lose...
I know. Exactly.
Whereas to lose your entire investment here, as news is about to break, with 30 minutes to go, the odds that it expires literally to the penny where you get in at, that's not going to happen most of the time. So even, let's say that it expires 20 cents up or 20 cents down. You're getting that 20, that's $20.
We're going to do both of them. We're going to do both of them here.
Okay.
Because I think that the movement... If I'm wrong in the direction, I think the movement's going to be more than 50 cents. That's the bottom line.
Okay. Yeah, no. So then that would be right. So you could be wrong, but you're looking for a big move regardless of the direction.
Right. So
So how many contracts do you want to do?
Just
two of each? Three of each?
Yeah, just two of each.
Two of each. All right. So again, we're buying it over here.
Yeah.
Selling it over here. Now this is shifting a little bit as it's 2 pennies away from it.
Okay. Okay, good. Okay.
And there we are. We're in them both. Perfect.
So, now this is where this could be...
Where do you want to have... maybe a potential order to,
no, I should.
to get rid of them, right?
Right.
Now you could almost, this is the bearish one. We're keeping the bearish one on the left and the bullish one on the right to make, because this can get confusing, you know.
Right.
We now have two active positions.
Right.
One's bullish, one's bearish. We're long one, we're short the other.
Yeah.
So what kind of value would you be looking on either side of this for? Like, we got in at about 25 cents, right?
Yeah.
So what are you looking to get back? Your principal, maybe? Is that what you're looking for?
Well, before the numbers come out, what I'd like to do is put the top of that range is 51, right?
The top of your profit potential.
Yeah.
Yes, that's your max profit is 51.
If we put in 50, 75, and maybe we get a spike there.
You would need, if you're going 50, 75 for your order to get hit, that means oil is going to have to be decently above 51.
Okay.
Just to, not decently, but definitely above it. Just to put it, you know what I mean? To be exact how far, but it would be about 25, 50 cents above it, because there's still going to be, I mean, you're talking about there'd be 28 minutes left. We're talking, we're looking for that spike right away, right?
Okay.
There'd still be 28 minutes left.
Yeah, let's put that in there anyway. Put it in there. That 50, 75 on that side. Okay. And then I'm going to go 40.
Let's go, you should go for 50-50, because that's $1 in value, which would actually be 100% return if you got hit on that. This is where I think you might be going.
Okay, good.
Because what you have to keep in mind is this can swing back, right? What we've seen before is if you get hit on one side, right?
I'm going to put both of them in, though.
Okay.
Yeah. Do you see what I'm saying?
I do. I think that you're looking, though, in this one, and this is good, we're having this whole conversation, 49.50, right?
Yeah.
This order, if you're putting this in at 50.75, that's going to be $1.25 over the current market.
Right.
But then there's got to be more money that's in there that's going to be premium when this goes up. So that means you're going to need about $1.50 to $1.75 in underlying movement before this gets hit. That's what I'm just trying to make sure that you're you know.
So what are you saying? Put it in 50-50?
That's what I was thinking.
Okay, good.
Yeah. Because that's $1 on each side. You have two contracts, that'd be $200 back.
Okay.
You double your investment, and you have the other side.
Okay.
And that might be more realistic for within the half-hour span to get both sides. So yeah, you'd be selling this at 50-50.
Okay.
Yep. And then you're going to be buying this one at 48.50.
Right. Good.
Right?
Okay, cool. Okay, this is going to be wild.
Yeah. Because ideally, we see these and they swing, right?
They do.
So you want to have, if you're going to, if you're looking for that, let's put it that way. You know, sometimes you're just going to ride out one side.
Right.
Okay. And in that case, maybe you do want to. You're saying, I think that I'm not going to play for like the swing back, right? I think the news is going to break and it's just going to go.
Yeah.
Well, then, yeah, you can go for 80, 90% of that value. But if you want that swing back, you want a realistic probability of that get hit, right? Yeah, so now you have, it can get $1 spike up, you get hit, and maybe it pulls back down. That would be the mother of all, for sure.
Yeah, it would. Yeah. Stay right there, folks. Tommy and myself are coming right back. Dow's up 102, Nasdaq's up 30, S&P's up 8.5. We're going to be right back. Welcome back, folks. So crude imports fell, well, let's see.
Oh, boy. We had a decline of 3 million barrels, and it was looking for a rise of 1.5.
And
that's the top line. We'll see what it says. But, man, look at that spike. This has been 50 cents in the last 15 seconds, 20 seconds.
So we spiked up to like 49.80 or 49.70 something, and then down to 49.30.
49.76 to below 49.30, back up to 49.60. And we're within 6 pennies of where we were when we made the trade. Now, that's not what we want.
No,
but this type of action is pretty good for what with 30 minutes. If you had 5 minutes left, I'd be worried. But with 30 minutes. Now, so let's talk about theoreticals, right? So here are our working orders.
Yeah.
And what's interesting, we said maybe people are doing similar trades out there, right? Because guess what? Here's our order that we have for 2. And there's 2 more out there on each one, which is purple. Yeah. Totally. So we have 48.50 or 50.50, and we'll see where those oscillate. Now, you could bring those down, too. We were just talking during the break, right? So with it being $1 above the floor and $1 below the ceiling in each of these, we're kind of going for, that would be $100 in value per contract. Yeah. So you get $200 total because you have 2 contracts.
Right.
And the risk reward was $100 for both of these trades, which is the 4 legs that you put in to initiate it. Because it's 2 contracts, 2 legs. And, we'll see what happens as it's happening. These are, that's quite an acceleration. So you could have set those even smaller, right? Where maybe you're saying, okay, maybe you just get your investment capital back, in which case you could shorten it by 50 cents on each side. And then really what you're playing is you're really looking for a bouncy market in that case.
Right.
This is good action.
We're at 49.25. The bottom line is that I don't want it to stay in the middle, though.
No, you don't. But I mean, just to put it in perspective, right? We have 27.5 minutes left out of like the 35 that we had when we made this trade. And I'd say anytime you're looking for volatility, and if you said after that the 5-minute bar at 10:30 was going to be a, what are we at now? Like a 70-cent swing from high to low?
Right.
That's decent.
And it would end up happening because I was bullish. This is a better trade.
I wasn't even thinking that. Yeah.
This is definitely a better trade.
Definitely a better trade.
Because I would have lost that money flat
Well,
out.
we'll see. Yeah.
Well,
I mean, you have no value until above 49.50, so that's obviously a worse trade than the one you decided to make, which is, right now you have still $14 you're getting back. And so put it in perspective, too. That's a decent chunk of what, you have defined risk. You realize that that's basically all risk capital because guess what? Sometimes it is going to just bounce around and then happen to on the 11 o'clock dot, which you're prone to. And that's just like variance, and I don't want to call it luck, but guess what? When you're trading 25-minute binaries, spreads, you could just get a bouncy market, and guess what? Maybe it goes all over the place and just happens to cross at 11 o'clock.
Right.
And you just have to be aware of that because it's all risk capital, and, you'd get back a substantial amount of money if it expires anywhere within there, as opposed to going directionally where you're completely out of the money, and you're losing the entirety of that trade at least half the time. Because think about it. Half the time it's going to go up, half the time it's going to go down, in theory. Unless you're directionally correct in it. But in theory, half the time it's going to go up, half the time it's going to go down. So if you're getting in 25 cents away from the current market, then half the time it's going to go up, half the time it's going to go down. And guess what? Half the time it goes in your direction, it's not going to go far enough.
Exactly.
So all of that.
Exactly.